I'm Sharon Kreider. I'm a CPA and an enrolled agent in Sunnyvale, California, and I'm here for Western CPE on a video e-tax alert with some news for you about S-corporations. There's a recent chief counsel advice I want to talk to you about or explain a little bit about. It's when your client comes in and talks to you about his new business and he says, I don't know what kind of entity to be. Maybe I should be a limited liability company. Maybe I should be an S-corporation. I want to tell you just a little bit of news that might favor the S-corporation for some of your clients in the real estate industry. So the Chief Counsel Advice, which is 2012 237017. So this is the Chief Counsel Advice 2012 37017. And in the Chief Counsel Advice, the question is asked, if an S-corporation with its two shareholders, if an S-corporation is a developer and they have a basis in their S-corporation in the assets inside the S-corporation greater than the liability, can they liquidate the S-corporation and recognize a loss? So that's basically what I'm going to tell you about on the S-corporation liquidation. And let me give you just a quick example. You and I are shareholders in this development corporation. We have spent on construction $10 million on building a building in Modesto or Las Vegas or whatever. Our construction mortgage is $8,000. The value of the development has dropped below $8,000. Say it's dropped below $8 million. Say that the value has dropped to $7.5 million. If we liquidate the corporation, you know under Code Section 336 that at the liquidation of a corporation where the assets are distributed, it's as if they were sold for their fair market value, the $7.5 million, but sold for no less than the amount of the liability if the liability is higher than that. So in my example, we've spent $10 million. We have an $8 million construction loan. You and I, as shareholders, have put in a couple of $1 million to this project. If we liquidate under 336A, the Chief Counsel says that we can recognize our loss. So we liquidate, distribute the assets, we recognize our losses. We, of course, are limited to basis in the S-corporation, but you and I have put $2 million of cash into this. So we're recognizing an ordinary loss on the sale, at the liquidation, at the sale of our development project. Then immediately thereafter, we take those assets that were distributed, we transfer them in, we contribute them to a new limited liability company, and we continue with our development. How's that sound to you? We have figured out, because it's an S-corporation, that we can trigger ordinary losses. It will take some extra work on our part. We'll want to confirm fair market value. That might be some sort of an appraisal that we do. There's more detail to this, which I will provide to you and have provided to you in an email describing some of the provisions. I want to point out to you that the same result would not happen if we had organized as a limited liability company. In a limited liability company, when we dissolve our LLC and hand out the assets, the general rule is those assets go out with the basis that the LLC had. Therefore, we don't recognize any loss until we've actually disposed of the assets in a taxable transaction. This makes the S-corporation as an entity for our developers and our realtors, real estate investors, much better for them in recognizing losses. So that's our video tax alert for you on a new Chief Counsel Advice. I'm Sharon Kreider.